Welcome back to the channel. Today we're diving deep into the world of dividend ETFs and exploring three specific funds that could set you up for a strong 2026. Whether you're actively investing, planning for retirement, or just want a steady stream of income from your portfolio, this video is for you. Now, last year didn't quite play out the way many expected. The market surprised a lot of people by climbing even higher than anticipated, leaving investors scratching their heads. And as we step into 2026, uncertainty is still everywhere. Interest rates are coming down, geopolitical tensions remain, and tech stocks could swing in either direction. So the big question is, how do you position yourself to generate both growth and reliable income in a market like this? The answer might lie in carefully chosen dividend ETFs. These are funds that focus on companies paying strong, reliable dividends while offering long-term upside. Today, we'll focus on three ETFs that stand out for 2026. The Fidelity High Dividend ETF, FDVV, the Vanguard Real Estate Index Fund, ETF, VNQ, and the Schwab U.S. Dividend Equity ETF, SCHD. By the end of this video, you'll have a clear understanding of why these ETFs are worth considering, how they could benefit your portfolio, and the kind of returns and income you might realistically expect. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with FDVV, the Fidelity High Dividend ETF. This fund is designed for investors looking for a combination of income and growth. FDVV invests primarily in large-cap and mid-cap stocks that not only pay dividends but also have a history of increasing their payouts. It uses what's called a smart beta approach, meaning it evaluates potential holdings based on dividend yield, payout ratios, and growth trends to optimize performance. Over the past year, FDVV returned almost 15% including dividends, which is very competitive compared to the S&P 500. What makes it even more attractive is its sector allocation. Technology makes up about 26% of FDVV, whereas in the S&P 500, tech is closer to 35%. This lower tech exposure provides some insulation if the tech-heavy sector corrects in 2026, while still allowing investors to benefit if tech continues to grow. FDVV's dividend yield sits at 2.87%, which is modest but steady, and the ETF has a very low expense ratio of 0.15%. That means for every $10,000 invested, you're paying just $15 annually in fees, a tiny price for the potential long-term growth and dividend compounding. One of the big advantages of FDVV is the focus on dividend growth. Companies in this ETF are not just paying out a fixed dividend, they are growing their dividends over time. That compounding effect can really accelerate your income if you reinvest the dividends year after year. For long-term investors, this is where FDVV shines. In simple terms, if you want a dividend ETF that balances growth with income and keeps risk lower than the broader market, FDVV is a solid pick for 2026. Next, we have VNQ, the Vanguard Real Estate ETF. This fund focuses on real estate investment trusts, or REITs, which are companies that own, operate, or finance income-producing real estate. REITs are unique because they're required to distribute at least 90% of their taxable income to shareholders, which means they naturally offer higher dividend yields. VNQ has historically been more income-focused than growth-focused, and in 2026, it could shine if interest rates continue to fall. Why? Because REITs are sensitive to interest rates. When rates are high, borrowing costs rise and real estate becomes less attractive. But as rates decline, REITs often see increased demand, higher valuations, and even stronger dividend payouts. Over the past year, VNQ has been fairly flat, but that doesn't mean it isn't worth considering. Real estate markets have been resilient, and REITs have learned valuable lessons from previous downturns, including the 2008 crisis. Many of these firms are now stronger and more financially disciplined. The dividend yield on VNQ is 3.92%, which is solid for an ETF, and it comes with an ultra-low expense ratio of just 0.13%. For context, this is only $13 per $10,000 invested annually. For investors seeking a reliable income stream, VNQ offers a combination of stability, growth potential, and a relatively high yield compared to traditional equity ETFs. So, if you're looking for a dividend-focused ETF that could benefit from falling interest rates and deliver consistent payouts, VNQ is a compelling option for 2026. Finally, let's discuss SCHD, the Schwab US Dividend Equity ETF. This fund has been around for a while and is known for its strong dividend yield and consistent performance, though it hasn't kept up with some of the newer tech-heavy dividend ETFs in recent years. In fact, SCHD's capital appreciation has been range-bound for the past 4 years, largely due to its low-tech exposure. Tech only makes up 9.7% of its holdings. At first glance, that might seem like a disadvantage, especially given how tech has dominated the market over the last decade. But here's the thing. SCHD's strength is stability and reliability. It focuses on companies with strong fundamentals and high dividend yields without taking on excessive risk through option strategies or aggressive sector bets. SCHD's dividend yield is 3.78%, and its expense ratio is just 0.06%, which is remarkably low. That's only $6 per $10,000 invested. Even if the price of SCHD doesn't skyrocket, the dividends alone provide an excellent source of income, and over time, those dividends can be reinvested to accelerate your wealth building. Looking ahead to 2026, SCHD could see a breakout if the market rotates away from tech-heavy sectors or if monetary policy shifts in ways that favor dividend-paying stocks. While it's been overshadowed in recent years, this ETF has a track record of resilience and reliability, which makes it a solid foundation for a diversified income portfolio. Now, you might be wondering, why focus on dividend ETFs at all? After all, some investors chase high-growth stocks or speculative tech picks. The key difference is between accumulating wealth and distributing wealth. When you're in accumulation mode, your goal is to grow your portfolio as fast as possible. But when you're approaching retirement or need income from your portfolio, dividends become crucial. They provide a steady cash flow, which can cover expenses without having to sell your investments during market downturns. In fact, recent reports show that many Americans are realizing they could retire earlier than they thought, just by structuring their portfolio around reliable income streams like dividend ETFs. Answering 3 simple questions about your expenses, income needs, and investment allocation can completely change your retirement outlook. Suddenly, retirement isn't decades away. It could be much closer than you imagined. Dividend ETFs like FDVV, VNQ, and SCHD allow you to earn while you sleep, reinvest dividends, and keep your portfolio growing, even in uncertain markets. They're a great way to hedge against market volatility while still participating in long-term gains. To summarize, here's what makes these 3 ETFs stand out for 2026. FDVV, balanced growth and income with strong dividend growth, moderate tech exposure, and a low expense ratio. VNQ, income-focused, benefits from falling interest rates, and offers a high yield through real estate exposure. SCHD, reliable dividend payouts, rock-solid fundamentals, low expenses, and potential for a market rotation boost. 2026 could be a make-or-break year for the market. Interest rates are coming down, tech stocks could either soar or stumble, and geopolitical and economic factors remain unpredictable. While no one can predict the future, you can position yourself with ETFs that deliver steady income, growth potential, and long-term resilience. Dividend ETFs aren't just about surviving the market. They're about thriving, especially if you're planning for retirement or building a portfolio that pays you along the way. Reinvest those dividends, stay patient, and over time you'll see how a well-chosen income-focused portfolio can outperform in ways that speculative growth chasing sometimes can't. So, if you're looking for ETFs to carry you through 2026 and beyond, the Fidelity High Dividend ETF, FDVV, Vanguard Real Estate ETF, VNQ, and Schwab US Dividend Equity ETF, SCHD, are a strong starting point. Focus on long-term growth, reliable income, and a strategy that fits your personal financial goals, and you could set yourself up for a very rewarding year. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.